The year 2020 saw all three Singapore banks posting a fall in full-year net profits. In the first quarter of 2021, the tide has turned as the banks booked higher profits. The earnings outlook for the rest of the year also remains robust, despite the continued uncertainty over the COVID-19 situation.
There's always something new to be concerned about. And right now, certainly there are infection rates that are rising everywhere, Thailand, Malaysia, India. Having said that, I think the Singapore economy indicators are looking good. And despite the infections in the region, I think we would see economies on the mend. So I think in general, we're going to be looking at the results that would be better rather than worse at this point at least.
Against this backdrop of an improving economy, the bad debt situation has remained under control, and asset quality has actually improved as some sectors gradually recover. Even if the current pickup in infection rates does lead to more pain for the hardest hit sectors like aviation and tourism, analysts are confident that loans to these sectors won't turn sour. In Singapore, debt holidays for the hard-hit sectors will expire after June.
Majority of the exposure to aviation is to your national carriers and also maybe to global lease companies. In reality, we know the carriers and airline industry in general are facing huge stress. But at the same time, we also know that there's a lot of government support. And you can even see from the bond prices, some of these national carriers' bond prices are still at investment grade, although you virtually have no business for the past 1 year. On the hostel or hospitality side, most of these loans are asset-backed.
And if the loans do go bad, observers say the banks would have been prudent enough to already account for most potential bad loans.
I don't think you're going to see tourism coming back anytime soon, even in the later part of this year, at least not in droves, right? So there would be NPLs. But the point, though, is that most of the banks would already be very clear on some of these companies and would have provided for them, so they're not going to hit the P&L.
While bad debts are expected to be manageable, one headwind for the bank's core interest income could come from low interest rates globally. This would hurt net interest margins or NIMs. But there are bright spots.
We think that the interest margin compression has stabilized. Interest margins will stay compressed, but it's not going to, or not likely to get worse, and potentially some minor upside.
Low interest rates also mean business and consumer loans are now more affordable, and that will in turn spur credit growth.
We do expect higher loan growth and asset growth to offset the weakness in margins. So therefore, net interest income should stabilize from here and going forward.
Currently, 2/3 of the Singapore Bank's income is from the interest they earn on their loans, and the remaining 1/3 comes from non-interest income such as trading gains or fee income. Wealth management has become an important source of this fee income for the banks.
Fees for wealth management has been a very strong performer for the banks in the first quarter. That's been supported by strong capital markets condition in the first quarter as the market anticipates an economic recovery. Now, we may see that some of that growth ease off in the second quarter and for the remainder of 2021, depending on the capital markets condition.
With ample capital buffers in place, asset quality improving, and the operating environment for the banks remaining favourable, the banks have the scope to increase their dividend payouts in financial year 2021. Analysts say they can pay out dividends similar to the scale of 2019's levels, subject to relaxation of the dividend caps imposed last year.
The financial capacity is there. The banks have actually either maintained or strengthened their capital level last year. They have made a lot of provisionings and a lot of management overlay for their potential bad loans. So I think the capacity to revert to the pre-COVID level of the dividend payout is there. I think the only variable is how the MAS will respond.
The regulator had taken a conservative stance last year during the height of the pandemic by capping dividends. But we believe at the time, the Singapore banks did have the capacity to maintain their dividend payout even last year. So we do expect the banks to recover their dividend payout to FY19. That is subjected to the regulator's position.
After paying out dividends, and if the banks still have sufficient buffer, analysts see them going for acquisitions if a suitable target comes along.
We're looking at the recent acquisitions. Historically, they have been in the geographies that the bank are already operating in, that has a strong presence in, so for example, in Greater China and the rest of the Asia region. So we see a similar type of acquisition going forward.
These analysts think there will be interest in Citigroup's consumer assets that are up for sale in Asia. Citi has said it will exit from its retail banking operations in 13 markets, 10 of which are in Asia. The 10 Asian markets include China, India, Indonesia, Malaysia, the Philippines, Thailand, and Vietnam.
If you look at the Citi consumer business, they are in jurisdiction that the Singapore banks are interested in. So I think they can rapidly expand the customer base and footprint. But I think the main variable is the price, right? They have to bid for it at a price that makes sense.
Other analysts are less upbeat on Citi's assets.
All the banks would need to be very selective. To take the Citibank example, they have been here a long time. And you would argue that some of the challenges that they face, a Singaporean bank would likewise face. One of the questions you have got to ask is, what do you think you can do better than Citibank after they have tried for 2 decades or more?
Shares of the 3 Singapore banks have rallied so far this year on optimism over their earnings prospects.